In a matter of days, the largest IPO in history is going public. SpaceX is set to list at around $1.77 trillion, raising $75 billion in a single stroke. Nothing this big has ever hit the US market. And it's only the opening act. Behind it, OpenAI, Anthropic, Databricks, a wave of AI listings worth nearly $3 trillion. It's the most AI-concentrated IPO year ever recorded. So here's the question every investor is asking in 2026. Do you buy in? Because there's an uncomfortable truth hiding under all the excitement. We'll look at both sides, the once-in-a-generation companies and the brutal track record of buying hype, and you can judge for yourself. First, the size of what's coming. SpaceX, OpenAI, Anthropic, targeting a listing near $900 billion. Databricks, around $134 billion. Add the pipeline up and it's worth close to $3 trillion, and roughly 9 of every 10 of those dollars are an AI bet. There has never been an IPO year this concentrated in a single theme, and SpaceX is in a league of its own. The previous record IPO raises were Saudi Aramco and Alibaba. SpaceX's $75 billion raise would tower over both. This isn't a normal new listing. It's the biggest financial event of the decade. And why is it all happening at once? For a decade, the hottest companies simply stayed private. Flooded with venture money, they had no reason to list and answer to public shareholders. That has flipped. The funds that backed them need to finally return cash to their own investors. And with AI valuations at record highs, this is the window to sell. The result is a once-in-a-cycle traffic jam of giant companies all heading for the same exit at the same time. $3 trillion of hype is about to ask for your money. But step back and ask the question almost nobody asks in the excitement. Why now? Companies don't go public out of generosity. An IPO is the moment early investors, founders, and venture funds finally get to sell, and they choose the timing. They tend to choose when valuations are high, demand is frothy, and buyers are eager. Put plainly, an IPO is, by design, insiders selling to the public. And the whole machine is built for that. The underwriters, the investment banks running the deal, are paid to price it high and sell it fast. The roadshow is a marketing campaign. The timing is deliberate. And on the other side of that polished trade is you. You're being offered shares exactly when the people who know the most want out. That's not cynicism. It's just incentives. And the historical record of buying that excitement is sobering. So let's look at what actually happened to the last decade of hyped tech IPOs. In the first week after listing, most of these names were winners. About 57% traded above their price. Exciting. But watch what time does. By 6 months, that dropped to 43%. By 12 months, still 43, fewer than half. The median stock went from up 20% at 3 months to down 9% after a year. The longer the hype had to meet reality, the worse the odds got. The day one pop is the easy part. Surviving the year is the hard part. Now the part the highlight reels skip, the drawdowns. Across this group, the median stock fell at least 54% from its peak within the first year. Robinhood dropped 90%. Rivian, 88%. Lyft, 79%. Coinbase, 57%. Snap, 56%. Even Facebook, the single most successful name on the list, fell 54% before it ever became a giant. A 50% plus crash wasn't the worst case here. It was the typical one. A median 54% drawdown is the normal experience, not the nightmare scenario. And there's a built-in second wave of selling. After an IPO, insiders are usually locked up, barred from selling, for 90 to 180 days. When that lockup expires, a flood of new shares can hit the market at once, just as the launch day enthusiasm fades. It's one reason so many hot IPOs quietly sag a few months in. The early money is finally cashing out. Mark the calendar, 3 to 6 months after listing, the insiders get their exit. If this feels familiar, it should. The last great IPO frenzy was 2021, A record year for new listings, right at a market top. Robinhood, Rivian, and Coinbase all went public into that euphoria. Within about a year, they were down 60, 70, even 90%. The companies were real. The timing was the trap. Record IPO years tend to cluster near market tops, not bottoms. So is the lesson just never touch an IPO? No, because the upside is real too. Some of these listings were spectacular. Palantir is up over 150% from its debut. Zoom, about 140. ARM Holdings, over 130. And remember, Amazon, Google, and Nvidia were all IPOs once. Refuse every new listing on principle and you'd have missed some of the greatest investments in history. Tomorrow's biggest winners are somewhere on this list too. But here's the catch that separates fantasy from reality. Even the winners were brutal to hold. Palantir, up 150% overall, still fell more than 50% along the way. Amazon, the greatest IPO story of all, crashed over 90% after the dot-com bubble, and still made early holders extraordinarily rich, but only the ones who never sold. The reward was real, but only for investors who knew exactly what they owned and could sit through a brutal crash without flinching. Hype alone never carried anyone through that. Winning needed the right company and the nerve to survive it. Which brings us to the question that cuts through all of it. Are you buying a business or a story? In this whole AI pipeline, most of the candidates are not yet profitable. The standout exception is Databricks. $5.4 billion in revenue, growing 65%, generating real cash, and keeping customers at a retention rate above 140%. You can argue about the price, but that is a fundamentally different proposition from a company selling pure narrative. Separate the company from the stock, and the story from the price. So what do you do with a once-in-a-generation IPO wave? Quick note, I'm not a financial advisor, and this isn't financial advice, just how experienced investors tend to approach new listings. Don't buy on day one. The first day pop is engineered for the sellers, not the buyers. The price is at its most emotional, and you're competing with no information. Wait for the lockup to pass and let the company report a couple of quarters as a public company. You'll learn more from one real earnings call than from a year of pre-IPO hype. Judge the valuation, not the logo. A great company at an insane price is still a bad investment. That's the entire lesson of the dot-com era. And size the position for the volatility. If it can fall 50%, which, remember, is the normal outcome, and that would ruin you, it was simply too big. And maybe the most underrated move of all, let someone else go first. You almost never need to own a company on day one to do well over a lifetime. Waiting a year, or simply owning it later inside a broad index fund once it's seasoned, lets the business prove itself while you skip the most dangerous, most emotional stretch of its entire life as a public stock. Missing the first 20% of a great company is a tiny price for avoiding the median 54% crash on a mediocre one. And zoom out one last time. A record flood of IPOs concentrated in the hottest theme in the market, all arriving at once. That itself is a classic late-cycle signal. It's the smart money raising cash near the top by selling the story everyone most wants to believe. So, should you buy the IPO boom? Two things are true at the same time. Some of these are genuinely historic companies. And over the last decade, fewer than half of the hyped IPOs were even positive a year later. So the odds of beating the market on any single one were, historically, worse than a coin flip. The smartest position isn't FOMO, and it isn't blanket cynicism. It's clear eyes. Know what you own, know who's selling it to you, and know the price you're paying. If this helped you think more clearly about the biggest IPO wave in history, subscribe. One big market question every week. And tell me in the comments, which of these IPOs, if any, would you actually buy? See you in the next one.